Hello, everyone, and welcome to our webinar today on the recent tax amendment in the DRC, which was introduced by the adoption of a new tax law, and that will significantly change both the corporate income tax and personal income tax systems in the country with effect from 1 January. I'm pleased to be joined by David Guarnieri and Thomas Jolivet, both partners at Littell Holly, a tax specialist firm in the DRC, to explore these amendments in further detail. Welcome, Thomas and David, and thank you for joining us. To the audience, if you have any questions, please feel free to post them in the Q&A box. If there's time left at the end, David and Thomas will respond to those. Otherwise, they'll respond by email afterwards. So welcome to everyone, and without further ado, David, Thomas, over to you.
Hello. Hello, thank you everybody. And thank you, Celia, for hosting us at your webinar. So the purpose of the webinar today is to introduce the new corporate income tax and personal income tax reform in the DRC that has been enforced by the law number 23054, dated 30th of November 2023, and which will be applicable as from the 1st of January 2026. So that reform is part of a global reform of the DRC tax system that started in 2003, with, first of all, in 2003, the reform of the tax procedure to secure and to simplify the filing, the payment, and the recovery of taxes. And then with the implementation in 2012 of VAT to replace a former turnover tax regime, which was a cumulative tax based on an old mechanism. And despite the improvement of the existing tax code, which was dated 1969 in the DRC, through the yearly finance laws, it became necessary for the DRC authorities to proceed with the significant change of the tax regime and the income tax regime. And the taxation, indeed, in 2069, and the current tax code, I would say, was, based on taxation of type of incomes. That is to say, you have a separate tax regime applicable to rentals, applicable to movable incomes, applicable to capital gains, applicable to salaries, applicable to professional income. And certain of these income, depending on the fact you were a company or an individual, was not taxed, with the consequence of having an unfair regime applicable, as with the same amount of income during the year, you could be taxed differently. And there was also an absence of clarity between the tax regime applicable to companies and the tax regime applicable to individuals. And finally, the 1969 regime was no longer compliant with the international standard that applies over the world. So with this new tax regime, which will apply as from 1st of January 2026, you will have a corporate income tax which applies to companies, and a personal income tax which applies to individuals. And the tax calculation will be based on the annual net global income, that is to say, cumulative of all type of income you earn during the year, with, for consequence, to have a regime similar to the international standards and which would adhere to the objective of the DRC to adhere to OECD and BEPS. You will have a simplification of the taxation with a clear tax regime applicable and clear principles. And then you will have a more equitable regime with more transparency. Even if such application and such implementation still need some application or implementation decrees to be issued and enforced, the regime will be applicable in few weeks. So let's start now with the corporate income tax, and then we will go through the personal income tax. Thomas, over to you.
Thank you, David. So let's start with the scope of corporate income tax. Quite a large scope in terms of taxpayers, because the law identifies 3 ways of falling into the scope of the corporate income tax. The first one, the simplest one, which is the type of company which has been set up in the DRC. As soon as you are a private limited, public limited, or simplified private limited company, you will be subject to the new corporate income tax. You may be as well subject to the corporate income tax if the company does not have this type of form, provided the company carried out some lucrative operations. Finally, some what is classically called a transparent or translucid type of companies, partnership eventually in English, which are usually not taxed at corporate income tax, but the members of these entities are directly taxed depending on the regime. They can opt for being subject to corporate income tax. In such a case, the option will have to be filed at the level of the tax authorities within the first 3 months of the year for which the entity is supposed to fall into the scope of the corporate income tax. Note, nevertheless, that a partnership, transparent entity, which before having been transformed was SAS, SARL, public, private, or simplified private companies, can in any case not be subject to corporate income tax. So all these entities which shall be taxed at corporate income tax will be taxed on their taxable profit at 30%, or a minima for an amount corresponding to 1% of the turnover. The highest of the 2 hypotheses were appropriate. This is not new. This principle was already implemented under the former IBP, the former form of corporate income tax, let's call it like that. The revenues to be taxed, to be concerned, will be, the list is quite large in the law. We won't go through all of them. We've just identified a couple of interesting aspects. First of them, naturally, the sales or service provisions. For the sales, the law refers to the date of the effective delivery of the good to be taken into account to allocate such a revenue to a specific fiscal year. This notion will certainly have to be defined by the tax authorities in order to avoid time-consuming discussion within the frame of the tax audit. For the services, same. The law innovates, giving some indication on the generating act to take into account. We have to refer to the date of provision of the services, which is quite interesting because in practice, we we have met in quite numerous of time some assessment for, notably in the construction sector, by the tax authorities trying to allocate some prepayments received from the clients to a specific taxable year, despite the fact that the services of the construction have not been provided yet. A word as well quickly on the rental income. So the rental income is listed as taxable income under the corporate income tax. Nevertheless, it must be kept in mind that there is still a taxation of rentals paid notably to individuals and eventually to companies which are not qualified as real estate companies, a tax called RAL, a former tax as per the schedule regime David was referring to in the first slide, which had been allocated, transferred to the competence of the province. So in such normally rare hypothesis, some clarification will have to be obtained from the government on the articulations between the corporate income tax and this RAL for the rental incomes. And maybe as well a very short word on the assets disposal, notably the capital gain and the forex exchange gains. Nothing has changed here as per the former corporate IPP, let's call it like that. These revenues are going to be taxed only if the capital gains has really been realized as well. That's the case as well for the forex exchange gain. So we've just reviewed broadly the scope of application of the corporate income tax, notably for the resident, for the entities having been formed in the DRC. The question remains on the criterion to be used to qualify the residents for non-resident companies, and I let David to continue on this one.
Yeah, on the permanent establishment rules, so the new Income Tax Act provide with some common principles, but with some innovation compared to the 1969 tax code applicable in the DRC. So first of all, on the principle, a foreign entity is subject to tax if it has a fixed and permanent place of business there. So that is to say the usual criteria, an office, a branch, a plant, factory, a warehouse, a mine, or oil well present in the DRC. So this is quite common. In absence of a fixed and permanent place of business, so then a foreign entity may be considered as having a permanent establishment in the DRC and taxed on its income if it has some professional activities there, so if it carry out a professional activity under its name for 3 months. So here, 2 comments. The first comment is the law does not say if this should be 3 consecutive months or 3 months over a certain period of time, 12 months, for example. So for the moment, we only have in the law a 3 months period required in order to have a permanent establishment by carrying out professional activities. And this is changed compared to the current tax regime, as according to the current tax regime, it was a 6 months activity during the year in order to be qualified as professional activity and having a permanent establishment. The second aspect is to have an activity of provision of services. through the presence of staff locally based in the DRC. And once again, we've got the two same comments as professional activities. First, this is for a presence of 3 months. So not sure about the fact that this must be 3 consecutive months. And the second aspect is that according to the current regime, this was 6 months. So in fact, the law divides by 2 the criterion of physical presence in the DRC in order to have a permanent establishment. Something new compared to the 1969 law is the existence of a construction project without having a permanent place of business. And here the construction or installation project must last at least 6 months in order to be qualified as having a permanent establishment. So this is an innovation of the 2023 law compared to the current tax code. 2 other aspects, quite common. First of all, the existence of a permanent establishment in case of presence of a dependent agent in the DRC, that is to say, a dependent agent having the authority to represent and to engage the foreign entity and to conclude contract on behalf of the entity, and to have, for example, stock located there for an activity of purchase and sale. The 6th aspect is on the insurance operation. So here the tax law has made, I would say, a parallel with the obligation in terms of insurance in the DRC by mentioning that collecting insurance premium or covering risks that are located in the DRC suppose the existence of a permanent establishment, except in case of reinsurance, but this will be linked to the realization of insurance activity in the DRC. Indeed, according to the insurance code, to the DRC insurance code, it is forbidden for an offshore insurance company to cover or to insure risk located in the DRC, meaning in order to cover DRC risk, you must be a duly appointed DRC insurance company and appointed by the DRC authorities. So, in fact, the tax regime applicable to insurance operation is the copy-paste of the obligation that is mentioned by the insurance code. This is for permanent establishment rules. Let's go to the deductibility of expenses. So we did not go through all the expenses and the rule applicable to all expenses, but we have decided to highlight certain type of expenses that may be important of the DRC activities.
Actually, David, maybe the first one, personal cost. Not many changes with respect to the rules governing the deductibility are discussed under the former IBP. Nevertheless, under the former regime, the deductibility of the benefits in kind was accepted by the tax authorities, provided the said benefits in kind were duly taxed at personal income tax. This rule has been extended to all the type of personal cost, which may have an impact, notably within the frame of the tax audit, because we could assume that when the tax authority is going to audit a taxpayer and an employer and will reconstitute the taxable basis as per different method the tax authorities may adopt. The difference between the reconstituted basis and the amount which had been declared to personal income tax will be nonetheless taxed at personal income tax, but as well added back to the corporate income tax to be taxed at 30%. So we could assume a minima 30 plus 30 and eventually 25 of former exceptional income tax on remuneration paid to expatriates. So something to anticipate while declaring on a monthly basis the different remuneration paid to the employees. Innovation on the marketing expenses, the goodies will be considered as deductible from the corporate income tax basis, provided they are below a threshold corresponding to 2 per mil of the turnover. We could have faced some time-consuming discussion again with the tax authorities on the qualification of such goodies between a gift or a proper commercial promotional item. Now it's clarified, and we could expect having limited discussion on this specific aspect with the tax authorities. Nevertheless, remain open the discussion on the eventual commercials or visual and so on publicity to be engaged by a taxpayer, and the direct link with the and on the correct value of these with respect to the corporate purpose of the company. Depreciation rates, quite a massive change here. Until now, the rules were governed by the former tax code, 69 Ordinance Law, plus a circular dated 1989, which was giving us some broad indications on the appropriate rhythm of depreciation or depreciation rate, depending on how you refer to. So reference to the use of the industry plus 4 proposed rate for different type of equipment. Here in the law, there is a direct reference to a ministerial order which shall give us some rate applicable to each type of equipment. This ministerial order had been issued during the Q1 of 2025. Now we have a list of equipment, a type of activity with the corresponding depreciation rate, which is going to be accepted by the tax authorities. Neither the law nor the application decree explicit if these rates are a maximum authorized for depreciation or must be exactly respected by the taxpayers, which may have an impact eventually at the end of the depreciation period. Furthermore, it may create some questions when these rates, which have been administratively fixed for tax purposes, differ of the proper expected life of the fixed asset. If, in other words, if there is a discrepancy between the expected life as per the CFOs principles and the expected life as fixed by the Ministry of Finance in this application decree. And if there is a discrepancy, and if the taxpayer intend to adjust the rhythm of depreciation, it will have to be probably clarified if this applies exclusively to new fixed asset, entered into service post 1st of January 2026, or to the existing assets in the current fixed asset register, and if and how the condition of modifying the rhythm of depreciation as per the CFOs going to be implemented by the taxpayer and validated by the statutory auditor. So some clarification to obtain and some work to be done in-house by the different taxpayers on this new depreciation rate rules. Another innovation, during many years, we may have faced some discussion again with the tax authorities on some assets that the taxpayers may have considered as expense of the year and that the tax authorities qualified as fixed asset to be depreciated, notably with respect to the low value assets. There is now administrative value which has been provided by an application decree. Every asset below 500 USD can be booked as an expense of the fiscal year and will not have to be depreciated. Last comment here on a new rule appearing in this reform. According to Article 20 of this reform, the sums which are subject to a withholding tax or to a levy will be accepted as deductible from the corporate income tax basis, provided the withholding tax or the levy has been correctly withheld. The way the article is drafted is a bit confusing, notably if we have to refer to the withholding tax which has been supported and then booked as an expense of the year, or if we refer to the basis of the withholding tax, we assume it is the second option. In such a case, remain as well open the type of withholding tax or levy the law refers to. Does it only refer to the levy this law institutes by itself, notably the 14% levy to be withheld on services provided by a non-DRC supplier? Or does it refer to any type of withholding or levy which may be applicable to different type of payments as per the different laws of each sector? I'm thinking eventually to the 1.2% of the RSP, which is a subcontracting royalty applicable to any payments processed to a subcontractor, a DRC1, or eventually the 5% withholding tax payable to the DGRAD/Ministry of Industry in case of payment of royalties under certain circumstances. Just basic example, something which have to be clarified in the next weeks or months, or if not, which have to be experienced by the taxpayers within the frame of tax audit.
So before I forget, just coming back a few seconds to the permanent establishment rules that are defined in the new tax code that will be applicable as from the 1st of January 2026. Of course, some double tax treaties, and especially the double tax treaty concluded between the DRC and South Africa, provide its own residency rules and criteria to be qualified as having a permanent establishment in the DRC. Of course, such residency rule as per the double tax treaty will prevail compared to the substantive law. So this must be, at least for South Africa and Belgium, which are for the moment the two binding double tax treaty applicable. Residents from South Africa and Belgium will have to refer to the double tax treaty in order to determine if they have a risk of permanent establishment. On the interest and royalties, so effectively some new rules applicable regarding the deductibility of these expenses. So on the interest first, there has been a lot of changes and a lot of restriction, especially regarding interest on loans concluded with related parties. So we've got a principle and then we've got multiple condition and restriction to the deductibility of interest. So the principle is, provided the loan has been granted for business purposes and is used for business purposes, so therefore the interest paid is deductible. On the exception or exclusion or restriction, the first one would be a general restriction, which is applicable to interest on loan that have been granted to shareholders of private limited company, what we call SARL, or which has been granted by the sole shareholder of a DRC entity. So therefore, if you are not a company by share, that is to say a private limited company, or if you have only one shareholder and the shareholder is granting you a loan, then the interest will not be deductible. Second step on the shareholder's loan condition. So in order for the loan to be deductible, so let's exclude the SARL and the fact that you are in a company with a sole shareholder. So three main conditions will apply. First of all, the interest rate must be limited to the interest rate of the central bank of the DRC plus 2 points. The second condition would be to have a duly written and registered loan agreement, taking into account the fact that registration of loan agreement has not been defined and according to the existing rule does not exist or is not mandatory if we are talking about notarization. So this will be required to have some clarification from the DRC authorities. And the third condition would be to have a fully paid up share capital in order for the interest to be deductible. A fourth condition, or I would say a kind of additional restriction, which is a kind of thin cap rule applicable in the DRC, is that if the loan has been granted by a shareholder having de jure or de facto the control of the company/borrower, then the interest would only be deductible if the loan amount is less than the amount of the paid up share capital. Finally, the fourth condition, the fourth restriction on interest deduction would relate to a broader type of lenders, that is to say the related parties, the offshore related parties, and in such a case, interest on loan granted by these offshore related parties would be deductible if 4 cumulative conditions are met. The first one would be the repayment of the loan, of the principal of the loan within 5 years. Then you must have a benchmark of interest rate, that is to say, interest rate must be equivalent or at arm's length compared to an interest rate that could be paid to a non-related party. You will need to have a transfer pricing documentation in place supporting the terms and conditions, that is to say, the interest rate in place. And then the deductible interest would be capped at 50% of the adjusted taxable profit, that is to say, the taxable profit plus or minus a certain type of adjustment in terms of expenses or incomes. So that is to say, the objective of the legislator as regards interest has been to, we could say, avoid as much as possible the deductibility of this interest. So reflection will be to have banking loan in place, and especially local banking loan, to avoid potentially a restriction in terms of interest deduction. As regard royalties, so on the existing tax code, there is no restriction of deductibilities of royalties. And the definition of royalties, first, according to the current tax code, is given by the income tax that is applicable to such type of income, which is not corporate tax but a specific tax, and such definition of royalty is similar to the OECD definition of royalty that was in force in the 70s. During the last year, the DRC authorities have significantly extended the scope of royalties and have not limited the royalties to copyright, trademark, use of industrial equipment, etc. They have significantly extended that scope. And what is surprising is that in the law that will apply as from the 1st of January 2026, the concept of royalty has been restricted only to copyright, to trademarks, and to equivalent IP rights, which have not been defined in the law. So again, something to be clarified about the scope of royalties, but compared to the current scope of royalties, it has significantly been reduced. And what is, I would say, an innovation of the law is that from the 1st of January, there will be a cap of deductible royalties to 3.5% of the yearly turnover. Again, we may have some gray zone regarding the application of that limitation, as the law does not refer to the basis or the type of royalty to which the 3.5% limitation apply. That is to say, should we apply this to the whole amount of royalties charged during the year, or should we apply to each type of royalties that has been charged based on the copyright and trademark agreements we have in place? So again, we expect implementation decrease to come clarifying the application of that rule on royalties. On the next slide, payments to non-residents, we leave it to Thomas.
Thank you, David. I'm going to try to be quite quick, so we have time for questions at the end. This slide refers to the payment to non-resident. The question is, does it cover exclusively the services or something else? Quite ambiguous when you have a look on the text. Nevertheless, the three conditions which are on the slide, that is to say, be able to prove the reality of the service, the fact that the service cannot be provided by a local provider, and that the fair market value is applied, could lead to think that this applies exclusively to services, management fees, and so on, and not to eventually interest, royalties, and other type of cash flows. With respect to the three criteria, quite classic, already present in the current IBP law. In practice, we notice that the main criteria the tax authorities are using as the be able to prove the reality of the service provided out of the DRC, and the fact that such services cannot be provided in the DRC. That is to say, notably, they are quite reluctant to accept the deductibility of services related to HR, accounting, and so on. And a lot of work has to be done in order to demonstrate the fact that these services are not and cannot be provided locally. On the arm's length principle, we notice the fact, yes, you have to notice the fact that the transfer pricing regime should, in 2026, via the finance law for 2026, extend and which will give much more tools for the tax authorities to go deeper into this third criterion. A quick comment as well on the notion of related party. Article 53 extends largely the notion of related party. It will apply only in case of relative majority. If a foreign direct or indirect shareholder is considering as having a decision-making or management influence, or via the voting rights, may be considered as having an effective control. Same, if two entities are considered as have common directors in their boards, they would be considered as being affiliates. And a bit more strangely, they as well introduced as a criterion the fact that an economic dependence by contractual terms inconsistent with market would qualify the related party relationship. This will have to be put in perspective, and notably with the innovation to be brought by the new finance law for 2026, but that's not exactly the topic of the current presentation. A last word on the non-cooperative jurisdiction. No matter if there is any any affiliation between the service provider and the DRC client, as soon as the service provider is located into a non-cooperative jurisdiction, the services will be considered as not deductible. There is a definition, quite broad, of such a non-cooperative jurisdiction into the law. There is an application ministerial decree which has been issued during Q1 2025, which give more indications on how the Ministry of Finance will determine which country has to appear into that list, but the list of the non-cooperative jurisdiction is still awaited.
Thank you, Thomas. So on the loss carry forward, so once again, the law applicable in 2026 will be a little bit more restrictive than the current one. So a little bit of history regarding loss carry forward. In the 1969 code, the first situation would be to have an indefinite, that is to say, to have the right to offset 100% of your loss against your first profit, but within a limitation of time of 5 years. Few years ago, the DRC authorities have changed that rule by limiting the level of offset of the losses to 60% of the tax profit of the year. Meaning, even if you had some loss carry forward, then you would have to pay a minimum corporate tax, as you were not entitled to offset 100%. And in counterpart of that limitation in the level of offset, the carry forward losses could be carried forward indefinitely. With the new corporate income tax law, we come back to the old regime, that is to say, you are entitled to offset 100% of your losses against the tax profit of the year, but you must do this within the 3 next year. So it's no longer 5, but 3. After 3 years, your loss carry forwarded are cancelled. And regarding deferred depreciation, that could be used in order to indefinitely carry forward your depreciation cost, then the law says that it must be treated as ordinary losses, that is to say, to be used within 3 years. So based on that reform, we could consider that the DRC authorities intend to strengthen a little bit more the use of carry forward losses and do not pay attention to big project supposing a lot of investment and supposing large losses during the first year of activity with offset over the duration of the project. So this would be something to address to the DRC authorities, taking into account the fact that, again, from a pure implementation standpoint, we do not know at this stage if such a rule will apply to losses that will be realized as from the 1st of January 2026, or if that rule will apply to losses that have been realized prior to that period, which would be quite unfair and which would significantly reduce your right to offset the losses that you suffered during the former year. Let's come to the personal income tax.
Thanks, David. First, on the scope and on the rules governing the residents, taxable person, naturally individuals, and the classic rules, non-resident individuals will be taxed on the DRC source income only, but the resident individuals will be taxed on the worldwide income to be eventually adjusted as per rules governing the double tax treaty, rules mentioned and provided by the double tax treaty. Again, on the residence criteria, classic, has a permanent home in the DRC, you have a permanent home in the DRC, you will be considered as a resident. Same if you carried out your principal professional occupation in the DRC, or if you stay in the DRC for more than 183 days during a 12-month period. Here, the tricky aspect may eventually, for foreigners, to be in the DRC for less than 183 days, so being not qualified as a resident personally. But if he stays in the DRC to provide consultancy or services for more than 3 months, he may qualify his employer, or if he's in professional, as having a permanent establishment from a corporate income tax purposes. The main innovations on the personal income tax when you compare with IPR, which is the former acronym of the taxation applicable to individuals, is the fact that the capital gains will fall under the scope of the payroll tax. Meaning that an individual which sells, here in the example we decided to describe sell a real estate, will have to first be subject to the personal income tax at the time of the sale, and will have to declare it on the 30th of April of the following year. So with respect to the real estate, the sale of the principal residence will, as in most of the foreign jurisdiction, will be out of the scope of the personal income tax, exonerated. The law provides some definitions on the notion of principal residence, and notably the fact that you must have lived in that place for more than 5 years, except if you move prior 5 years for professional reasons or personal reasons, notably. or for new projects. The law provides as well some interesting rules governing the basis of the personal income tax on the sale of real estate, notably on the calculation of the prior acquisition price for the seller and for the new purchaser on the selling price, in order to calculate the capital gain realized by the seller. Notably, and that's why we shall need to have some application decree, the law refers to the constant franc value of the acquisition price for the seller of the present operation. That is to say that we shall need to have some guidance, yearly guidance from the tax authorities, confirming the constant counter value for each year. A difficulty, obviously, on this taxation is that the purchaser is supposed to withhold 20% of personal income tax on the capital gain to be realized by the seller. So the seller will have to be transparent, and the purchaser will have to be cautious. This withholding tax will be offset on future payroll tax to be declared on the 30th of April by the seller. But the effective implementation of this major innovation will have to be scrutinized in detail in the next couple of years. On the investment income, will not be taxable at payroll income tax. The share premiums, for instance, some income which shall not be artificially considered as non being distributed. You've got as well some exoneration, notably all the interest related to deposits made by individuals into a bank account or on some savings. This in order to give some incentives to the constitution of savings by the individuals. I will not go through the other income categories, which does not need a proper development here, and I let David continue.
Yeah, so you are an individual who you are at the end of the year, so you accumulate all your yearly income, and based on your annual global net income, you apply a yearly progressive tax scale, which corresponds to the one that is currently applicable. This progressive tax scale will apply to your global income with a cap of 30% of the total income. And once you have done that, you have your, I would say, gross amount of personal income tax due. Then you will apply a family charge relief, which corresponds to a 2% reduction per dependent. And the number of dependents is limited to 9. And such 2% reduction will apply to the whole amount of the personal income tax, except the personal income tax, which applies to the last scale of the progressive tax scale. So you will arrive at a net personal income tax due. And once you have your net personal income tax due, then you are entitled to offset from the net income tax due the amount of withholding that have been made on your income during the year by your employer, which has to withhold on a monthly basis personal income tax from your remuneration, on your movable and dividends from the company paying you dividends, and from your capital gain as a purchaser as withheld at source 20% of the amount of the capital gains. And then you arrive at a final personal income tax to be declared and paid. Regarding the filing, even if once again there may be some, I would say, a few clarification to be provided by the DRC authorities on that. In any case, two deadlines. First of all, is the 15th of the month, which is the deadline for payment of the personal income tax that is withheld at source, mainly by the employer, and your annual declaration per individual will be submitted by the 30th of April every year. In conclusion, Thomas?
Yes, the last slide, probably the most important before we go through a few questions. We've been through the main rules governing corporate income tax, personal income tax, but obviously, as you've noticed, we're going to face some outstanding technical issues, obviously, and implementation challenges. First of all, corporate income tax, as the former IBP, the deadline for payment, declaration and payment is the 30th of April of the following year. It gives rise to the payment of corporate income tax, as well as the previous IBP, gave rise to a prepayment of installments corresponding to 80% of the tax declared for the previous fiscal year. Typically, in 2025, 80%, some provisional payments of IBP, up to 80% of the previous tax liability, have been declared by the different taxpayers. Logically, on the 30th of April 2026, it will be the last IBP return to be declared and not the corporate income tax, but we don't have clear guidance from the tax authorities from which the prepayments of IBP will be offset. Nevertheless, even for 2026, some guidance will have to be received from the tax authorities in order to determine if some prepayments of the new corporate income tax will have to be paid, and if so, on which base? Will they be based on the previous IBP liability of the taxpayer? It would be good to obtain some clarification from the tax authorities on this one. Same from the payroll income tax. IPR has been declared in 2025 by the employer, withheld and declared. Nevertheless, with the modification of the law, the two classical filing deadlines have disappeared from the law. That is to say that logically, on the 15th of February, the employer is supposed to declare the yearly remuneration and the yearly tax withheld for each employee. This 15th of Feb deadline does not appear in the law anymore after the reform applicable on the 1st of January 2026. Same, normally the employee is supposed to file online most of the time a declaration of remuneration which had been subject to withholding tax by the employer. The article governing this obligation does not appear anymore into the law. Does it mean that such a declaration will not have to be done, despite the fact that on the top of that, the 30th of April for individual declaration of personal income tax relates to personal income tax and not the former IPR. Therefore, again, guidance from the tax authorities is expected in the next couple of weeks. That's the transition challenges. The substantive issues, quite a few. First, the law proposed a reform of the substantive tax code. Nevertheless, in the DRC, you may have a lot of sectors or activities which are governed by sectorial laws, which sometimes propose some preferential tax regime. Obviously, the most iconic one is the mining code, which shall need to be amended in order to reflect the new taxes and the fact that most of the taxes in the mining code will not exist anymore in 2026. Same for the investment code, agricultural code, and so on. Again, quite an innovation. You've noticed that we've not discussed about any withholding tax on dividends to be paid to foreign beneficiary. The dividends are going to be taxed in the hands of the resident individual, or in the hands at personal income tax, or in the hands of the resident company at the corporate income tax. Nevertheless, dividends paid to foreign shareholders are not taxed. Same for royalties. Royalties paid to a foreign supplier for the moment is not subject to any withholding tax. Same for interest. I will not enter into too much details for the royalties on the 5% withholding tax to be applicable eventually for the payment to be paid to the Ministry of Industry. Again, IERE, exceptional income tax on the expatriates, had been removed from the law, but had been replaced by a levy. The law governing the IERE, notably those which have been the principles which have been recalled via decree or ministerial order, notably on the exemption for residents coming from countries with a common border with the DRC. We don't know if they're still going to apply from the 1st of January 2026. Same for the withholding tax applicable to foreign services. There is now a levy. It's not a former IBP applicable to non-resident. It's a proper levy applicable to this type of services. Will it be covered by the double tax regime? Quite a lot of gray zone to be clarified in the next months or years. Maybe to conclude, before I go through the questions, a shopping list of some homeworks to be done, notably for the existing taxpayers. First, to go through the fixed asset register, compare the depreciation rate with the new ministerial order. On the dividends, are there some dividends to be paid in 2026? If so, eventually taking advantage of an absence of withholding tax, going through the new definition of affiliates, and with all the possible consequences, the forecast of the losses to be carried forward, when do we expect to offset them, the intragroup financing, do we have to restructure everything in order to comply with the new law, the rates of the royalties, do we comply with the maximum 3.5%, and so on. So it was a short presentation of 1 hour and 5 minutes. Obviously, we've not been through all the law, but we just wanted to highlight the key changes and some gray zone which needs some homeworks from your side and as well from our side too. I see Celia is back on the screen, and I thank you again for hosting us.
Yeah, I think, Thomas, David, thank you so much for sharing this valuable information with us. I think if you look at the number of questions, you can see that it is a hot topic, and I think there's a lot of aspects. It's quite complicated and clear. Unfortunately, we've run out of time, but if you would be willing to do so, we will share the questions with you guys. And if you want to respond directly to the clients on the questions that I have raised, would that be in order with you?
Definitely. I've been through a couple of them, but yeah, I think we are a bit out of time.
Some of the attendees have dropped off already for other obligations, but I don't know if you want to spend maybe the next 4 minutes or so just to address maybe 2 or 3 of the key questions that you can answer, and then the rest you can deal with afterwards. Will that work for you?
Definitely. Let's start with the very first one. Will capital gains earned by individuals still be exempt of tax, or will it become taxable as from Jan 2026? As earlier mentioned, yes, the capital gains realized by an individual will be taxed at payroll income tax, with withholding by the purchaser and then a declaration by the seller on the 30th of April of the following year. Which corporate form would a foreign branch registration be considered? Presumably taxed at the CIT basis. Correct. Branch are quite not popular in the DRC. In the past, we've noticed only branches opened by Australian companies for different, probably for Australian tax purposes. In the DRC, the opening of branches are going to face some legal constraint with a maximum time period of 2 years and some as well an unfavorable corporate income tax regime as per the former IBP and the new corporate income tax. So yes, under the CIT, but I would avoid opting for a foreign branch in the DRC. A branch in the DRC of a foreign entity. Is the capital gain fully included in the taxable profit? Or just a percentage fully included? It shall be the difference between the sale price and the net book value for the companies, or the purchase price for the individuals. Is there any change on the withholding tax on dividends and interest, and whether the tax is due based? Yes, massive changes, because no withholding tax anymore, as per the current version of the law. So the comment on the rate of 20%, for the moment, it's 0. The other one is a bit long, so I'm gonna reply by writing. Double tax treaty, yes, true. The one service provisional activities. What in case double tax treaty says 183 days? Will the double tax treaty prevail? Definitely, notably the South African one will prevail on this new 3 months rules. I think we've done 10 of them. I think we've done the 4 minutes. We're going to reply by writing to all the other questions we may have received.
Thank you so much. Yeah, I think it all remains for me just to thank both of you for the time you've taken to put this together and to share your knowledge. For the attendees, I think if you've raised a question as an anonymous attendee, in order for Thomas and David to respond to you, we would need your email address. So please just share that with us. But I will also think if you need the contact details of Thomas and David, feel free to contact myself or your key contact at ENS, and we'll share their contact details if you want to liaise with them directly going forward. But yeah, thank you so much. I think it was very interesting and scary at the same time. I think there's some significant changes. But yeah, and thanks to our audience for attending, and yeah, we wish you a wonderful afternoon. Thank you.
Thank you, Celia, and good afternoon.
Thank you, Celia.
Bye-bye.
Thank you. Bye-bye.